So first off, before we get into the main content, I wanted to do an introduction to the DRS and what the DRS actually is. So DRS means daily rule set. And the reason I created this strategy is because I wanted to create something that completely removes all discretion from the markets. We are not looking for daily trends or daily biases. I also wanted it to be completely rule-based because eventually this is something that I do plan to automate. Now, who is this strategy for? Now, this strategy is very ideal for people that do have a busy lifestyle. So, for example, if you work full-time, it only requires either 1 or 2 hours of your day to at least be present and check the charts. With that time frame, the 1 or the 2 hours, you don't have to be sat at the charts for the entire time. You can just come back, glance at the charts. If the rules are met, you take the trade. If the rules are not met, you don't take the trade and wait for the next window. So within this introduction, what I'm going to be doing is showing you the entire framework of how the strategy works. And then we're going to be having a look at the results of how the strategy has performed over a 12-month period. So to start with, the stop loss sizing, we're going to be looking at 5 pips minimum up to 20 pips maximum. So this is for forex. We are looking at 5 pips minimum, 20 pips maximum. If the trade is beyond 20 pips needed, then we will not be taking the trade. And the reason we have 5 pips minimum is so we do have a little bit of breathing space when it comes to trading with a prop firm. Now, if you're trading on a personal broker and you have raw spreads, you won't really have that issue, but the same rules still apply for the sake of consistency. Now, risk management is absolutely maximum 1% per trade. Now, if your risk appetite is lower than that and you wish to risk less than that, feel free to do so. But for every single trade, we will be targeting 2R. No more, no less. So if you're risking 0.5%, then you will still be aiming for 2R, which means you will make 1%. If you're risking 1%, you will be then looking to gain 2%. The only time we will be setting stop loss to break even within this strategy is after 6 PM UK time. Now, the reason for this is because at that point, London has closed and the volume in the market has then decreased to the point where trades may not be moving much at all after this time. So we can only set stop loss to break even if we are in profit. If we are not in profit, then we just leave the trade up until the closing threshold. Now, all trades must be closed by 2100 hours UK time, regardless of floating profit and loss, to avoid widened spreads. So even if you're in a bit of drawdown or just a little bit of profit, as soon as it hits 9 o'clock UK time, that trade must be closed. Otherwise, as soon as we reach spread hours, even if we are in a little bit of profit, that spread widening could potentially take our trade out either at full stop loss or maybe beyond our stop loss. So we do not want to be risking that. Now, the max daily drawdown is 2%. If we have a 2% loss for the day, we must stop trading. Now, there's a couple of reasons I've put this rule in place. First off, this strategy, if you're trading one pair, will offer anywhere between 0 to 4 trades maximum per day, but there's only 2 trading windows that we're going to be utilizing. Now, if you are trading with a prop firm and or you are taking a challenge, this is going to give you much more breathing space to make sure that you are still within their risk parameters. It's usually the industry standard that it's 5% daily drawdown. Now, if you're hitting the 2%, then you still have a 3% window buffer with that prop firm, resulting in a less stressful trading environment. Now, we're only going to be using a 5-minute time frame, and the trading windows we're going to be looking at is the London trading window, which I'll refer to as LTW, and the New York trading window, which you will see as NTW. So the London trading window is 8 till 9 UK time. For New York time, that is 3 AM till 4 AM. Now, the New York trading window, we're looking at 1500 to 1600 UK time. And then in New York, we're looking at 10 till 11. And as I mentioned before earlier, the trade quantity is 0 to 4 trades per day. So fair value gap requirements. So fair value gap is the same as imbalance, if you're not aware. Now, the fair value gap needs to be formed within the trading window. If it's not formed within the trading window, then it's not valid. Now, this means that the candles that form the fair value gap has to be inside that window. We'll cover this more in depth in the fair value gap video, but if the very first candle that forms a fair value gap is outside of the window, or the very last candle is outside the window, then it is not a valid setup. We will only be looking for the candles inside that 1 hour trading window. Now, if the fair value gap is over 5 pips, then we will be using the equilibrium. Now, what that means is rather than taking the trade on the edge of the fair value gap, if it's over 5 pips, we'll be looking at entering on the center of the fair value gap. Trade and execution, all orders must be activated within the trading window. If they're not, then they are cancelled. And if a trade is activated inside that trading window, the trade can still be active outside of that window until it either hits stop loss or take profit. And as we mentioned earlier on, all trades must be closed at 2100 hours to avoid spreads widening. And any trades in profit after 1800 UK time can have stop loss set to break even regardless of how far in profit it is. So the main trading rules, providing the confluences do provide, are the fair value gap must be within inside the 1 hour trading window. Trades must be executed within inside the 1 hour trading window, and all trades must be closed by 2100 hours London time regardless of floating profit and loss. So let's have a look at some of the results from the 12 months of back testing for the strategy. So this strategy was tested for the entirety of 2022, and as you can see here, we have a total profit of 175% for that 12-month period. The win rate is 60% or 60.37%, and there was a total of 225 trades. Now, when you look at the trading journal that I've put a link to in the members dashboard, you will see that there is a slight difference between the trades taken and the trades logged. The reason is FX Replay hasn't logged the trades that were not tagged in. So you will see that there is a difference in the trades taken and the trades logged in the journal because of this reason. As you can see, the total winners, 131, the total losing trades were 86, so this is enough to keep us in that profitable threshold. And for a 12-month period, 175% is a very, very great year. So we don't need to have a high win rate. We don't need to be targeting high risk reward trades. A consistent 1 to 2 over a regular period of time with a decent win rate over 50% is still enough to be profitable. So here we can see the performance per day. Now we can see Tuesday does tend to be our most active day for both losses and profits. But looking at the performance for each day, this currently does not influence whether I would take a trade on one day or not. And if you have a look at the overall calendar just here for the entire year, you will see that there will be gaps of maybe a week where some trades just aren't valid. We might not see a trade opportunity every single day, but it does have the potential, if the rules are met, for 0 to 4 trades per day. Now, some trading sessions or trading windows will offer maybe 1 trading setup. Sometimes you might have 2. And when I say 2, you might have the first trade hit a stop loss, but then price reverse, but it actually then sets up a valid trade in the opposite direction. So we may have 2, or you may also have a scale-in trade. Now, every day that you take a trade, it's not always going to be a winning day. So as you can see, there is a few red days on there, but the green days, they overweight the red days quite significantly. Now, if we look at the bottom as well, you'll see performance per month. Okay, let me just go on to the next slide. Now, I just wanted to emphasize that these results per month are compounded. So each time I took a trade on FX Replay, the risk taken for the trades was from the initial starting balance, not the current balance as the account grows. So this is why you will see some months are in like 4%, 6%, and they tend to get lower and lower. But as you can see, the year to date is 175.39%. So each one of these months should be higher than what they are displaying. It's just the way that FX Replay displays the performance per month. It's compounded and not individually based off the initial balance. Now, one thing I wanted to point out before we close off here is, if you remember at the beginning, I said that this is suitable for people that are trading this is suitable for people that have a busy lifestyle. For those that maybe do live outside of the London time zone, you can see here the win rate. You can see here the win rate is consistent with London and New York. So the win rate is around 60% for London and 60% for New York. So if you were trading one or the other, you should still see the same results in terms of win rate and performance if you were only able to trade one of those timeframes. So that's the introduction for the DRS, or the daily rule set strategy. And in the next video, we're going to be having a closer look at fair value gaps and how we're going to utilize them.